Okay, so let's get going. As always, if you have a questions, put it in the chat. Probably I will go through the deck first, and then I will look at the chat and will be able to answer any questions that you might have. All right, so let's get going. Quick disclaimer: anything that you do after you watch this presentation, you only are responsible for it. I'm not a financial advisor or a tax consultant or an investment advisor. So this is not an investment advice. We are just here to share the knowledge and learn from each other. I see some new names in here. So a quick intro. I've been working in software industry for more than 20 years. Investment perspective, 15 years. Started with just stocks, became completely passive to ETFs because it's very difficult to keep up with the stocks while you are working full time. And really, I realized that always have to pick a direction in stocks, which doesn't work always. So then I moved to ETFs. Let's spread the risk, but the same story there. And now became more active in past 5 years and mostly towards option side. Investing philosophy, I think about risk before I think about the rewards, and I am in Bay Area. Apart from these sessions that we have on Wednesdays, which is specifically focused on options education, and then we also have a session on Saturday where we talk about general markets, stocks, trades, what's happening in market. We review companies in detail from building our own investment thesis. Apart from those two sessions, there are other ways you can connect with me on my YouTube channel. I do post some of the videos on YouTube. Haven't been doing that regularly nowadays because I'm getting busier into this, in boot camp and our Saturday series. But you will find a lot of other videos that, around most of the things that I talk about. For example, 2 topics, there is already a video on there. If you are a podcast fan, you can subscribe to OptionGig podcast and connect me over there, or on Slack, on Quora, Twitter, or good old Gmail, email, or through the website. So there are different ways you can reach out to me. Pick whatever works for you. All right. So as those who have been attending it for some time already know, that I would like to recap what we've already covered in some of the previous sessions. I don't want my students to forget. What did we do in session number 1? Session number 2, because unless you have a good grasp of that, moving forward becomes a little difficult. That's why this is a boot camp. This is not one-off lecture. We have been building the knowledge around options step by step, session by session. So whatever we have learned in the previous session is what we're going to use in the subsequent one. So that is why don't miss out on the session. Otherwise, you might be wondering in later sessions, what is Vivek talking about? So quick recap. We have gone through the very basics of what's an option contract. Then we looked at the 2 basic building blocks, put option, call option, went into the details of it. Then we also talked about 2 option strategies for complete newbie option trader, right? If you are being stock investor / trader all through your life and you want to try it options, just want to dip your feet in options, there are option strategies which would mimic the behavior of just a stock investor, right? Which is buying a stock or selling a stock, how you can make use of options to do it in a little better way. We talked about that. Then we started moving into areas wherein if you already put a trade, you will hear the terms in the money, out of money, at the money. We talked about that. That's called a moneyness of option contract. And last topic we covered was assignment exercise, how the whole process works, what is called a margin call, some words that scare new option traders. They always wonder, will I be assigned or not? Even though the option is expiring in 3 weeks, can I get assigned now? Stock has moved too far. So we talked about the whole process of how everything works, right? So far, so good. So that's all we have covered till now. And today I want to take you through two uh, topics. One is definitely the checklist. What's the checklist that you should run through? Or let me put it that way, what's the checklist that I run through before I look at a trade and confirm the trade? Then we'll talk about the spreads and see how we can make use of those on small accounts. And then if you still have some energy after a day's work and attending 2-hour session, I'll be around. We can open it up for some Q&A on a generic Q&A. Let's jump right into our first topic for today, which is the checklist for opening option trades. And when I'm talking about opening of option trades, my focus here would be that we are selling options, because that's what I focus mostly on. In the long term, being a net seller of options has worked out profitably. Does that mean that buying an option doesn't work? It could, but to be consistent in option trading, you have to be at least a net seller. At least that's what has been my experience. So everything that I'm going to talk about is from the perspective of we are a net option sellers. Then how should we think about on a particular trade and see if it is the right trade for us or not? I never recommend someone following some other people's trade, because when you get a trade alert, or when your friend calls up, or when your mentor tells you, I bought or I sold a put option at this strike price, got so much of a premium, you have no idea why that person would have done it, and does that particular trade fits your portfolio. So let's run through this checklist, and this is what you should use. You should memorize it, make it your muscle memory, put it up, post it, post it on your computer, on your desktop, on your table, unless it becomes a muscle memory for you. All right, first thing first, why I'm talking about the checklist for opening trade. Why is it so important to focus on opening the trade with our best possible way? Why not, when we think stocks, we just look at the stock. If we like it, we buy it. Of course, there's some analysis that you do to come to a conclusion that you want to buy it. But beyond that, there's nothing much. But when you're talking about options, there are a lot of other things that we need to worry about. And that's what we're going to do specifically on opening trade, because if you are an option seller, then the most important stage of a trade for an option seller is the opening trade. When I say stage in a trade, means you open a trade, and then if a trade goes against you, then you try to manage the trade. And then eventually you would close the trade. So now all the three phases or lives of the trade, the most important would be opening of trade. And the reason is because the maximum profit that you can make from the trade is already defined, is determined, it is fixed when you open a trade. The amount of premium that you have collected when you sold an option, be it a put or a call or a spread or iron condor straddle, I don't care, whichever option strategy it could be, but whatever option strategy you have sold, you would collect some premium. And that premium is the maximum profit that you could make out of that trade. After that, it is all about managing the trade if it goes against our thesis, or eventually closing the trade. So if opening determines what's the maximum money I can make in this trade, then I want to make sure I put my best foot forward at opening. That is why it is important to make sure when you're opening a trade, you are, putting your best team forward, putting your best foot forward. Because once you have opened a trade, after that, it's all management. You've already put a ceiling on what's the maximum amount of money you can make. And that will also make a difference in, how profitable could you be in trading options. If you focus more, if you open the trade more on the opening phase, if you open the trade at the right time with all the right criteria, that's what will determine, how long can someone stay in this game. All right, first criteria, position size. And those who have been, chatting with me or in some of my previous sessions, not the boot camp, but the prior ones that we did, knows really well. And I will, at the risk of, repeating it ad nauseum, I will continue to say that position size is the most important factor that determine the longevity of any option seller. So what's the guideline that I would use is, don't let the risk on any position to be more than 5 to 10% of your portfolio. When I say position, means a particular ticker. And this is the guideline which I follow. Now, depending on your portfolio size, say if your account size is $10,000, so this 10% could become, let's say, 15%, right? Don't let it go higher than that. But if your account size is $500,000, $300,000, then maybe stick to 5%. If your account size you're dealing with is $100,000 or $50,000, that, between 5%, 7%. And make sure that the risk in any single ticker, that means, say if I am bullish on Slack, ticker symbol WORK, and I do a put spread in it, and the risk in that is, maximum risk in that is $1,000. Okay. Say I'm assuming I have a $50,000 account. Now later on Slack moves and I want to take another position on Slack. I open up another put spread. I want to make sure that I don't let that put spreads, maximum risk to be more than, $2,000, $2,500, including both the positions. So this, always keep in mind, keep your position size in check. Because if you stay within the guidelines of position size, you will survive for, in long term. Don't ever violate the rule of position size. And I can't say that enough. All the bad press, all the horror stories that you see in, publications or on news channels where the talking heads talk about how risky these options are, all of them are because whoever was playing with the option violated the position size rule. So don't ever, ever, ever violate it. Because if you're right on this one and go wrong on everything else, I mean the rest of the criteria that we're going to talk about, you'll still survive. your name won't be called upon and mentioned in the newspaper on how this person blew up the whole account and more. You will still survive for long term. But if you do everything else right and go wrong on position size, then nothing will matter. And when I'm talking about the horror stories, right, those hedge funds who blew themselves up, those are not retail investors. Those are professionals. They manage hedge funds. They manage money for, more. They manage a lot of money for, a lot more wealthy people. So they know what they're doing, but the greed got better of them. They became too big on position size. And when you get too big on any one ticker, doesn't matter what your technicals are suggesting. Forget whatever fundamental analysis you might have done. Ignore that your CEO of that company is your friend and you know that company inside out. If you go too big and the stock goes against you, you won't be in the business. And whenever I read in newspapers around when they complain about how options are risky, I want to double click on it. I want to go into the details, see what exactly happened. And one common thread that I see is huge, big position size. Because sometimes the position looks, so I would say enticing that people forget about the risk, that what if it goes against you? So if you cannot imbibe this, if you cannot and you don't want to, abide by this rule, you can drop off from the session right away. Because like I said, nothing else will matter. If you violate this, you can do everything else right. Probably you will win, in 90 out of 100 trades or 9 out of 10 trades. One day, one trade will come and sweep everything away if you don't stick to the position size guidelines. I'm not saying this to scare. I just want to make sure that we don't know what might happen in markets. Only thing that will protect us is the position size. All right, second thing you should, so if, let's say I was taking an example of work, right? So if I already have a trade on a particular ticker and I get to know another trade, and I'm bullish, I want to do a short put spread or whatever trade, but I want to check back and see how much risk do I already have in this particular ticker. If it is already on the top side of the guidelines or the guardrails, I would ignore that trade. I don't care what's the profit probability in that trade. I don't care how much premium I might be getting in that trade. I don't care that the stock is gonna do really good. If it is already at the limit of my position size, just move on, find another one. Okay. Now, once you have determined that a particular ticker is well within your position size guidelines, next step, look at your portfolio fit. Right? You should look and see, do I already own a similar stock? Say if I'm looking at OIH, which is an oil ETF, and I don't have any positions in OIH. So position size guideline, check. I can do a trade in OIH. But I come to portfolio, if you look at asset diversification. Oh, I already have XOP. I have XLE. And XLE, XOP, both of them are very tightly correlated with the oil sector. And OIL is also an oil fund. OIH is also oil sector. So if I want to open up another position, it is concentrating me in oil sector. Right? I want to check if I already have oil or metal or whatever. Right? Is it gonna make me too concentrated in one particular sector? If yes, then I may want to stay away from it. And if it is already I have enough positions, then why would I need another trade? Don't do that. Maybe look for another sector. So that's first you look at the position size of the individual ticker. Look at whether the ticker provides you enough diversification or means it doesn't make it concentrated too much in a particular sector. Now, once you looked at that, it doesn't concentrate you in a particular sector, then you look at what's your overall portfolio direction is gonna, is it gonna help you or not? For example, let's talk about gets back to work. If I'm looking at a work and I want to take a bullish position because I use Slack at my workplace. I use Slack for doing, talking to retail investors, chatting with some of you. As I mentioned, we have our Slack group, right? So I'm bullish on what a Slack can do for me. So I want to do a bullish trade. But then I look at my overall portfolio. I'm like, my portfolio is already too bullish. And this might be coming as a little surprise for those who are here for the first time. Because if you're only doing stocks, then there is only one direction that you can take, which is bullish. You buy a stock, your portfolio is bullish, means you will only make money if the stock goes high. But if you're doing options, you can maintain your portfolio to be as bullish as you want, as neutral as you want, or bearish as you want. So if I'm trying to do another bullish position and my portfolio is already very bullish, I might think again, why do I need another bullish trade? What if market goes against us? My current portfolio will hurt. Why do I want to, pledge on and add sandwich another trade, which will profit only if the market goes high? If I'm not too overly bullish, I might do it. So this is very, at an individual level, you need to be comfortable. You need to think how bullish you want to make your own portfolio. Some people, especially those who are seasoned on option trading, they want to keep portfolio neutral, right? It's okay to make less money if stock goes high because I will lose less if stock goes low. I'll make money in both directions, but little, smaller in each case. It basically reduces the volatility in your portfolio. If your portfolio is skewed in one direction, either bullish or bearish, and too much skewed in that direction, you'll have a lot more volatility in your portfolio. So look at, before you confirm a trade, look at what's the portfolio direction. What is it going to do with your portfolio direction? And it applies not only when you're trying to open the trade. Sometimes I use this discretion when I'm trying to close the trade. So for example, today I was looking at one of the trades, which is, I'm a bearish on that. And it means if a stock goes down, I'll make my profit, I'll make more money in that. And that trade has already hit my profit target. I was about to close it. Then I realized this is giving me little bearish exposure to my portfolio. So even though the individual trade has hit the profit target, but if a market goes down tomorrow, this trade will help me. So I am like, okay, I'm staying away. I'm not closing this because it is helping me to neutralize some of my portfolio direction. So it's important you look at the portfolio direction. Next one, coming back to that individual ticker, make sure the stock that you're trying to deal in is very liquid. When I say liquid means there should be enough volume of the stock, underlying stock that's being traded on exchanges. Minimum 500,000 that's a, I would say is a good parameter for a stock being liquid. That is why I like a lot of ETFs, because they are highly liquid. You know, they trade in million or sometimes in tens of millions. Stocks like Nvidia, AMD, Netflix, Bank of America, all, you know, some of those big highly traded stocks, those are all liquid. So don't do you know, option trade in a stocks that are very illiquid. Means you see only 20,000 of those stocks are being traded. Because if you trade in a liquid stocks, you would notice that at an option level, the bid ask spread will be within few pennies. But if you pick up a stock which is illiquid, right? Maybe my Uncle Sam's Biopharma, and I know that, you know, I have an opinion and an outlook towards that biopharma company. But hell, only 20,000 stocks being traded. And then the bid spread would be so wide that you can drive a truck through it. I wouldn't do any option trades on that. And when you're doing it, check for the liquidity, not in your expiration period, but also one expiration month after that. Say right now, if you're opening the trades, you're opening it for September expiry. Now, if I'm doing a trade, say in Roku, I want to look at what's the condition of Roku, let's say in the October. You know, are there some, either the trades or are there enough option strike prices of Roku in October? The reason is, if the trade goes against you and the liquidity of the stock, it will provide you a lot of flexibility to manage the trade. Remember, when I opened this session, I said, once you open the trade, after that, it is all about management. So if you trade in a very illiquid stock, and if a stock goes against you, which it will, because it's very difficult to pick the direction of a stock. So it will go against you, but if it is not a liquid stock, you will find it's very difficult to manage it. And time and again, I've shared the case studies and we talked about it, that if a stock goes against you, you haven't lost everything. You could still manage it, convert it to a profitable trade, or reduce your losses. So those are the management techniques that we will talk about in later sessions of a boot camp. But if it is an illiquid stock, none of those management techniques you will be able to implement effectively. So liquidity is king. Next one I want to talk about is IV rank. Give me some pulse check. Everyone still able to follow, or am I going too fast? Okay, Venus says yes. Question from Raghu was regarding diversification. Does it apply to index ETFs too? In some cases, it could. For example, the XOP and XLE both are ETFs, but both are sector-specific ETF. So if you're looking at well-diversified ETFs, which is not a sector-specific, then you're already diversified. But if I'm picking up, let's say, XBI, which is biotech, I don't want to pick up another big trade on IBB, which is again a biotech ETF from a different issuer. So, all right, Lalit. Yeah, so IV rank, we'll probably talk about it in a later session. For now, maybe you just take a note as IV. So IV rank, so why is it important? Because for us as an option seller, our max profit is determined by the amount of premium we collect. So I want to make sure that I can collect the maximum amount of premium, or I want to open a trade when the market is able to give me more premium. The premium doesn't stay the same. It changes every second, depending on the situation in the market. Now, one thing that determines the amount of premium, and those who are nerds want to get into calculus, you can look up Black-Scholes option pricing formula, in which you will find a variable called implied volatility. That volatility determines what's the, how volatile could that stock be. It doesn't tell us about the direction in which it is going to move, but the magnitude. So keeping everything else the same, Slack work today, if it is implied volatility is 40, and a week later, if its implied volatility is 50, I will be able to get a more premium for the same strike price for the option which is at the same days to expiry, if I sell it when the implied volatility is 50. So higher the implied volatility, more is the premium you will get. Now, if you are a little active on earnings season, you will realize that near earnings season, you can get a lot more premium for selling options. That also means more risk. The reason is because in run up to the earnings, the implied volatility starts to rise. That is why you are able to get more premium near earnings. So now IV rank compares the implied volatility of a stock with itself. For example, and that gives me also a way to see, should I put a trade in Slack or should I do a trade in IBM? So for example, the 50 implied volatility in Slack could be higher because generally, historically, Slack implied volatility stays in 30 to 40 range. Okay. On the other hand, probably IBM is not a good example. Let me look at a biotech company. On the other hand, a biotech company has got today's IV at 50, but that might be low as compared to the historical IV of that biotech company, which generally stays between 70 to 100. So today, that biotech companies implied volatility is actually at the lowest end. In that case, my edge lies in doing a trade in Slack, not in the biotech company. And how we determine is what we use as an IV rank. So in this case, the Slack would have, let's say, an IV rank of 80, even though its IV is 50, it could have an IV rank of 60, whereas the biotech companies IV rank would be 30 because IV rank tells us where's the current IV lies between 0 to 100 as compared to where it has been in last 1 year. So I want to open up a trade when the IV in that stock is higher as compared to the rest of the times, right? It means there's a more chance that the IV will go down. It means there's a more probability of us making money in that ticker. When we are selling a premium, we are selling IV. If the IV goes high, that goes against us. So I want to do a trade when an IV of a stock is at a upper band, at a higher band, because then I know that over time it will come down. But that's not where it has been generally staying in last 1 year. So probably it will come down. So that will work for me. So that is why IV rank is important. So we will get into the details of other forms of IV percentile, IV rank, and in some other session, but net, this is what, it means. IV rank higher than 40 is ideal. 50, great. 60, 70, I will do a trade in it for sure. Provided the other two things we talked about, that my position size is okay, it helps my portfolio. IV rank higher than 40, I'll do a trade. Sometimes 30 is also fine. It'll work. It's okay, but it's not ideal. With a qualifier that in today's scenario, even an IV rank of 30 is good. And that is because what happened in March, that has skewed the IV rank. Okay. Now, if we are using Think or Swim or Tastyworks, you will be able to see the IV rank up front. Both those platforms shows IV rank. But if you are using other platforms, I'm not certain that they show IV rank, but any decent platform will definitely show implied volatility. Any platform that is, where option traders will hang around will show implied volatility. But if you are on a platform that does not show implied volatility, change your broker. That's it. I don't care whether that platform charges you 0 commissions. You will lose a lot more money because you're doing bad trades, because you're opening a trades when IV is not in favor, than what you will save in commission. So don't be, penny wise and pound foolish in that case. If your platform does not tell you what's the IV right now, move on. You need a better platform if you want to succeed, in long term on options. This is one of very important factor. Next, then I want to talk about strategy. Right? You might be thinking, why so late? Because most of the time when I get, when someone wants to, ask something, they'll tell me, the question that I get asked is, what ticker are you trading? What's the strike price and the strategy? I'm like, the strike price and strategy is way down in my criteria list. I don't want to be bothered about this unless we have done everything else. So after I've gone through, looked at the position sizing, check. It doesn't I don't get overexposed in that one particular ticker. If I look at, how does it impact my portfolio? Is everything okay from that perspective? Check. Then I look at, is it the right time to put a trade? Is IV in my favor? Check. Then I will determine, depending on what's my outlook is, then I'll talk about strategy. If I'm bullish, I could do a naked put, means cash secured put if you don't have a naked put privileges. Or I will do a put spread. Or, I don't suggest it, but just to make sure that I cover the whole aspect of all trading strategies, I could do a long call or a long call spread. Or if I'm bearish, I have a bearish outlook on stock, I think the stock will go down. That case, professionals and those who know how to manage risk can do naked call. No one else should do it. Or you can do call spread. Or if you don't have, or your outlook towards the stock is neutral, you know that it may go up and down like every stock does, in a usual course of business, but it will stay range bound. It will not move more than, let's say, $40 up or down in next 45 days. Say I'm talking about a Fastly. It's at $100 stock. Probably it will not go beyond 125 or lower than 75 in next 45 days because earnings is already out. In that case, I could look towards neutral strategies, iron condor, strangle, straddle. And don't worry if you are not familiar with these names. I'm just saying it because some of you already deal in some of these. So, or depending on your outlook, and that's a beauty on option, is depending on how bearish, how bullish are you on a particular ticker, you can create a trade which you can express your bullishness or bearishness. I am very bullish on a particular stock. Fine, I could do a naked put. Or I am slightly bullish. In that case, maybe I want to contain my risk. I'll do a put spread and I'll pick up a strike price accordingly. Or I could do an iron condor, which is skewed towards being bearish. So there are multiple ways. But at this stage is when we talk about what's the option strategy and the strike price. They go hand in hand. Right? If I'm very bullish, maybe I'll sell at the money strikes. I want to give myself little room for error because stock could come down, then I will sell out of money. Now, if a stock is today, right now it's trading at 50, I'm very bullish. I know stock is going to go high and I want to go all in terms of my bullishness. I will sell a short put or a put spread with a short strike at 50. That is at the money strike. But if I want to give myself a little room for error because I am bullish, but stock would come down from 50 to 48, 45 in next 45 days, possible, then I will sell an out of money put. I will pick up a strike price, which is 45. So at this stage is where I will start looking at, based on how bullish am I or how bearish am I will determine the strike price. And one other factor, and this is my recent addition because, I realized that we should talk about it because once you start managing it, you roll it. And I also want to check if I'm picking up $45 strike price, does that strike price exist in October month or not? Because if I were to manage it, I want to make sure I am able to roll it out to next month. Rolling out is another management technique. So the last point is nice to have. This one, but it's not must have. But if you have to make a choice between two tickers, you have same outlook on them, their IV rank is comparable, you don't have any trades on it already, so position size from that perspective both are same, and your portfolio can handle bullish, and the amount of premium you are getting is similar. In that case, I will choose a stock in which I have $45 strike in September, which is current month, as well as in October, which is back month. And I will not choose a stock which has got $45 strike in September, but on October, it's only got 40 and 50 and no 45. So if you have to compare between, if you have two choices, this is how you could determine which one to pick up. Okay. Then I look at a days to expiration. Should I do September? Why do I want to do a trade? Do I only want to play earnings? Is it an earnings trade? Or is it my regular trade in which I am bullish on it, so I want to do a short put, give myself a little room for error, and if IU comes down, I'll close it. So depending on what I am trying to do, that would determine how long should I go and pick up an expiration. Now, when I'm doing earnings specifically, and I think someone asked me yesterday or day before, in terms of why you're looking at only September, because I said that's my regular monthlies. But today I did, I think yesterday I did earnings trade, and that was for August 7th, because my focus is just to play the earnings which was announced today. So then I will pick up only the weekly. In some cases, if I want to do a stock substitution, in that case, I will do leaps. Leaps means those are the option strategies which go out more than 9 months out. So you could have January 2021, January 2022 options. Again, each one of them have a different risk and reward. So depending on what you want to do, that's how you should pick up your expiration. Most of my trades, 95%, I do regular monthly. Right? Now we're closing down on August. I started opening every new trade that I open now is for September. Once the September is getting closer to, the time frame where we start to roll down on September, I'll start opening October. Once in a while, I do earnings, which is weeklies, and very few leaps. So 95%, I stay with regular monthlies, and that's where most of the trades are. Because like I said, there are different risks. On a weeklies, I have a specific purpose because I want to take advantage of earnings IV crush. That's why I do weeklies. If I do the trade, which I'm doing in regular monthly, I add it into a weekly expiration, the risk profile will change. And the time that I have available, or my lifestyle or your lifestyle, may not give you a privilege, may not give you enough time to manage or review those weekly trades. So I don't do weeklies. Those who are full-time professionals or those who are day traders and can manage and monitor their positions, they do weeklies. I'm saying there's nothing wrong in doing those. Just understand that the risk profile is different. You will be exposed to a different type of risk depending on which expiration period you are picking. So that was, the days to expiration comes so late at the end. So that's all is a thought process I go through. And I know these are not, one or two checklist items. So when I was starting up, I wrote it down on a post-it. I stuck it on my laptop. And when I have to open up any trade, I will run through this checklist. Slowly and steadily, it will just become your muscle memory. Believe me, it took me a few months, and now, it just comes naturally. And also, once you start trading, you kind of develop whole awareness of what's your portfolio is, what you might already have in your portfolio. Some of the things you don't really have to go to position statement and look and find out. But some things like IV, things like your position size guidelines, expirations, those will become very muscle memory. Okay. All right, so takeaway, this is the order. Position size, very, very, very important. The most important. If you cannot follow this, ignore everything else. Nothing else will matter. Portfolio fit. Is it helping your portfolio? Liquidity. We don't want to get stuck in dealing with tickers which are not heavily traded. In options, you would want to be a small fish in a big sea. You don't want to be a big fish in a small pond uh, when you're dealing with options. So make sure there are a lot many players. There are many market makers. The stock is heavily traded. IV rank. If your platform does not show IV rank, start with IV. If it doesn't show IV, either you give up option trading or you give up your platform. Doing option trades without looking at IV is like you're putting a blinders on your eyes and then you're getting onto the road. You might survive for some months, but you know how that will end. So yeah, IV is important. Then look at your option strategy. What if you're bullish? You have multiple options, pun intended, available to express your bullish outlook. If you're bearish, you have multiple choices. Pick up your expiration date and your strike price. Strike price is based on how bullish or bearish you want to go. Expiration date will determine what exactly are you trying to play with. Are you trying to play with earnings? Are you just trying to do a regular theta decay? Or are you trying to substitute a stock with leap? Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.